Hi friends, welcome back to the Big Joy of Learning with Bijoy Ji. Let's continue with Money Matters Simplified. In the language of money, today we are discussing capital gain, investments appreciation translated into profit. Ever wondered how the appreciation of your investments translates into profit? This increase in value is known as a capital gain. Let's explore what capital gains are, how they work, and their implications for your financial journey. A capital gain occurs when you sell a capital asset, such as stocks, bonds, real estate, or collectibles, for more than your purchase price. The profit realized from this sale is your capital gain. To calculate your capital gain, subtract the original purchase price from the selling price of the asset. Capital gain is equal to selling price minus purchase price. For instance, if you bought shares of a company for 10,000 rupees and later sold them for 10,500 rupees, your capital gain would be 500 rupees. Capital gains are categorized based on the holding period of the asset. Long-term capital gains. In India, as per 2024 budget, all listed securities held for more than 12 months and other assets held for more than 24 months will be considered as long-term capital assets. Short-term capital gains. Other gains from assets held for 1 year or less. The distinction between short-term and long-term capital gains is crucial as they are taxed differently. Short-term gains are typically taxed at your ordinary income tax rate, while long-term gains benefit from reduced tax rates. Understanding the tax implications of capital gains is essential. Long-term capital gains tax, or LTCG. In Budget 2024, the LTCG tax rate saw an increase from 10% to 12.5%, while exemption limit was raised to 1.25 lakhs rupees. Short-term capital gains tax, or STCG. As in Budget 2024, the STCG gains from stocks, equity, etc. will be taxed at 20% as against 15% earlier. Other short-term capital gains are taxed as per the income tax slab rates applicable to the individual. If you incur capital losses, that is, selling an asset for less than its purchase price, you can use these losses to offset your capital gains, thereby reducing your taxable income. Long-term capital loss can be set off only against long-term capital gains. Short-term capital losses are allowed to be set off against both long-term gains and short-term gains. If you are not able to set off your entire capital loss in the same year, both short-term and long-term loss can be carried forward for 8 assessment years immediately following the assessment year in which the loss was first computed. Capital gains represent the profit from the sale of assets that have appreciated over time. Recognizing the types of capital gains and their tax implications is vital for effective financial planning. By strategically managing your investments and understanding how to offset gains with losses, you can optimize your tax outcomes and enhance your financial well-being. Continuing with the topic on language of money, we'll talk about some key financial terms everyone should know. Financial literacy begins with understanding the language of money. See you soon. This is Darpana signing off for now. If you found this helpful, don't forget to like, share, and subscribe to The Big Joy of Learning. Money Matters Simplified. Learn, grow, prosper. Have a big joy of learning.